Good afternoon, everyone. Thank you for joining us. Just before we get started, Krista, do you want to go over any of the little housekeeping items that we have for everyone?
Absolutely. Thanks, Joe. I just wanted to welcome everybody to PPP and Your Business, What Comes Next. My name is Krista McLaughlin. I am the marketing manager for Whisman Giordano and Associates. Just a couple housekeeping things before we hand it back to Joe. The session is currently being recorded and it is also live on Facebook. If you haven't noticed by now, everybody's on mute, but in the true spirit of a roundtable, we encourage you to use the chat feature. Please feel free to talk among yourselves and send questions to the panelists, because that's the whole purpose we're here for today, is to answer your question and to share the latest information. Following the event, you will receive a very short, by that I mean a 5-question survey. If you could fill that out, that would be great, as we are looking to do more of these in the future, and your feedback is critically important. That's pretty much it for the housekeeping. I will throw it back to Joe and just thank you all for participating.
Well, thank you, Krista. I'll reiterate what Krista just said. Thank you all for joining us today. In the interest of time, I'm going to keep my introduction short. I'm Joe Giordano, the president and managing partner of Whisman Giordano. We're a local regional CPA firm. Most of you already know us. We've been around since 1973, which is longer than, well, a few of us have been around. I see some of the names of the participants. So getting on with it, we've collected all of your questions through the registrations, and we're going to tackle as many of them as we can. However, as Krista said, please do not hesitate to send a question through the chat. There's a lot of information here, and we know that it's confusing, and we know it's information overload. So with that, one of the questions we got, and I'm going to tackle this before I introduce our panelists, we got a question about all of the financial reporting and accountability for the funds you received. One of the recommended but not required criteria, I guess, was to put the PPP funds into a separate bank account. However, you weren't required to. So if you didn't, it's really a documentation game, if you will. And you have to track every single thing that you spend these funds on. And you want to keep the backup and the documentation. So if it's payroll forms, if it's from your payroll provider, if it's mortgage payments or mortgage interest payments, excuse me, keep the check or the bank statement if it's electronically paid, etc. I don't want to get into too many specifics because of confidentiality. We do have a requirement to keep your information confidential. So if that's not detailed enough, our information will be provided for contact after this session. Please feel free to contact us and we can get into more details with your question. With that said, I'm going to introduce our panelists. First up, and I don't know what everyone else sees, but Lisa DeRose is in my top left corner. Lisa is a partner in the firm and the chair of our tax department. Next up, we have Dennis Perdue. Dennis is also a partner in our firm and is a tax partner specialist. And finally, we have Lalani, who's a manager in our firm. All of the people presenting today are specialists in tax for small, well, I'll say business in general. Most of our clients are small businesses like us and high net worth individual tax clients. And I'll say this, and many of you have heard me say this, they cringe when I do a tax return. So with that, let's get into the first question. Lisa, let's jump in. This is kind of two parts. First, can we go over some of the acronyms that we're going to be touching on throughout this presentation? And second, the original Paycheck Protection Program came out, I want to say it was late March, mid-March, somewhere in that ballpark. And then we had the Paycheck Protection Program Flexibility Act, which was about 3 weeks ago now. Can you walk us through some of the changes and differences that have occurred? I mean, there have been a ton of changes throughout this process. So if you could just summarize that for us, we'd really appreciate that.
Thank you, Joe. I'd be glad to. So some of the acronyms we're going to be starting with, and so everybody understands what we're talking about. The first one is PPP. That stands for the Payroll Protection Program. And then PPFA, the Paycheck Protection Program Flexibility Act, FTE, which is a full-time equivalent, and the EIDL, which is the Economic Injury Disaster Loan. This way everybody has an understanding of what these acronyms stand for. In case somebody says PPP, they know it stands for the Paycheck Protection Program. Now with the Flexibility Act that was just signed June 5th, there were some major changes made. The first one being the loan forgiveness period. Originally, the loan forgiveness or your covered period was 8 weeks. They extended that to 24 weeks, giving you more flexibility in order to qualify for the loan forgiveness. And another big change they made was the payroll / non-payroll costs. Originally, you were required to spend 75% of your funds on payroll costs. Well, they decreased that percentage from 75 to 60% needs to be spent on your payroll costs and 40% on your non-payroll costs.
I'm sorry to interrupt. Krista, can you go back one slide? I think you jumped a slide.
Yeah, you jumped on that.
Sorry about that.
I'll just keep going. She can work on that. But another change that's been made is with the Flexibility Act, there's been a 2 safe harbors that they added to the program. One of them being in relation to your business activity. If you can document, if due to compliance requirements, you cannot sustain the same level of business activity, you're eligible for one of the safe harbors. Another safe harbor would be your full-time equivalents. There's a period from February 15th through April 26th. If you see your full-time equivalents has declined in comparison to February 15th, you're eligible for this safe harbor that they added with the Flexibility Act. Another key point with the Flexibility Act is the extension of the loan deferral. Originally with the PPP loan, it was 6 months, but now they changed that. They changed that to when the SBA informs your lender. When the SBA informs your lender of your loan forgiveness amount, that's when the loan maturity really starts. And getting into loan maturity, they changed that from 2 years originally to a 5-year period for your loan maturity.
Thank you, Lisa. Just a couple of quick follow-ups for some clarity. In the loan forgiveness period, if you got your loan prior to June 5th, you get to you can elect the 8-week period still if you think you got full forgiveness.
Right. You have that option of electing the 8-week period, but that's all your preference.
Okay. And just to jump in, go ahead. Sorry.
I was going to bring up also, if you did receive your loan before June 5th and you have a 2-year loan maturity, you can speak with your lender and request maybe a longer maturity date.
And then we're relying on the bankers.
Well,
and unfortunately, I know there's one banker on the attendees because I saw the attendee list. I apologize. So with the 24-week versus 8, I'm just going to put in my 2 cents, and this is my business owner hat. If I wasn't sure that I had reached what I believe is full forgiveness, my recommendation and what I would do is I would elect the 24 weeks because that gives me the best opportunity to fully expend the funds properly to get full forgiveness. Is that a fair statement?
Absolutely. I would highly recommend that.
Okay. Thank you, Lisa. Just to jump in. Oh, hold on. We have a question on when do you have to elect the 8-week period by if your loan was before June 5th? I believe, and I think if I'm understanding the question correctly, you make the election on the form for forgiveness, and you have to apply for forgiveness. And Alex, Dennis, or Lisa, please jump in if I say this incorrectly. I believe you have to apply for forgiveness within 10 months of your loan date. Is that correct?
Yes,
Okay.
that is correct.
Okay. I think that answers that question. I think I understood it correctly. But it's really up to you when you apply for forgiveness. So moving on, Dennis, there are there's two major programs out there. There are a lot of minor programs, but the two major programs out there, which we've touched on just with the acronyms of EIDL and Paycheck Protection Program. Dennis, can you talk about the differences between these?
Sure, Joe. We have a table that you can use for a quick reference. It describes the major differences between the two. The EIDL, the maximum loan amount is $150,000, where the Paycheck Protection Program loan can be up to $10 million. Is the EIDL forgivable? Only the $10K that was advanced when you applied is forgivable. The PPP, yes, all of it can be forgivable under certain circumstances. Collateral required, possibly in the EIDL, no on the PPP. Credit check required, yes under the EIDL, no on the PPP. Automatic payment deferral is 12 months for the EIDL. For the PPP, it's until forgiveness application is processed or 10 months after the cover period otherwise. Where do I apply? For the EIDL, it's the SBA website. And for the PPP, it's either from like a financial institution, but there's other approved lenders like PayPal, Bluevine, that type of financial institutions. The loan terms, the EIDL is a 3.75% loan up to 30 years, 2.75% for nonprofits. For the PPP, it's a 1% loan. It's a 2-year loan before June 5th, 5 years after. And like we mentioned before, you can renegotiate with your financial institution to up to 5 years. The approved use of loan funds for the EIDL listed below: fixed debts, rent, utilities, payroll, accounts payable, basically your working capital. Whereas in the PPP, it's only usable towards payroll expenses, rent, mortgage interest, and utilities.
Thank you, Dennis. Just to touch on the PPP rent and mortgage interest, I haven't seen anything, and maybe you have, where what if let's just say I own a company, it's called an LLC, that owns my land and building, and then I own the operating company and that LLC has a mortgage, but the operating company pays rent to the LLC. Now it's a self-rental under tax law. I haven't seen any guidance on, do I have to choose the mortgage interest or can I use the rent? Have you seen anything on that?
I haven't seen anything. The last time I checked, self-rentals were allowed. I know that's a sensitive topic to most, but there's nothing that I have seen that disallows it.
Right. Thank you, Dennis. That's a big concern for a lot of business owners, because if I only get the mortgage interest, that's a much lower number than the rent, because most businesses that have that situation, they charge rent that would cover the entire mortgage, not just the interest.
Right. My concern would be that the documentation, and you got to remember, a lot of self-rentals aren't documented. And the documentation, from what I understand, needs to be documented before this happens. So if you do not have a document that outlines your lease agreement, it might not be forgivable. So you have to be careful with that. You can't do it today and assume that they're going to accept it. It had to be in place previously.
Thank you, Dennis. That's a lot of documentation, and thank God this isn't 20 years ago when we weren't paperless and everything wasn't scanned, because I can't imagine turning over all this paperwork to the bank and then the SBA. So thank you for that. Moving on, Alex, this is always a sensitive subject for the business owners on this roundtable, or virtual roundtable, I guess I should say. There were so many acts. There was the HEROES Act, the CARES Act, and now the Flexibility Act. And there have been a bunch of changes in the tax law that will affect various businesses. Can you touch on a few of these?
Sure, Joe. One of the biggest things that changed was the net operating losses. We call them NOLs for short. There are losses that were incurred in the prior years or current year that you were able to carry back or carry forward. Now, before the Tax Cuts and Jobs Act of 2017, we'll call it TCJA, the rules were that you could carry the NOLs back 2 years and forward 20 years. And there was no limitation. You could take 100% in a given year. And after the passing of the TCJA in 2017, carrybacks were no longer allowed, and they changed the carry forwards from 20 years to indefinite. So you can carry them forward indefinitely into the future. And then here comes the CARES Act. The CARES Act says, you know what, we'll give the businesses a little bit of a leeway here. So you can actually carry back your NOLs that occurred, prior to December 31st, 2017. It was tax year beginning before January 1st, 2021 to allow the NOLs. So you can actually carry them back. So there is an option here for businesses to carry back their NOLs. So 5 year is what's allowable for any NOLs that are generated beginning before December 31st, 2017 and before January 1st, 2021. And now the question becomes, what happens to the fiscal years? So the fiscal year 2017, you're allowed to carry them back 2 years. And then the rule from the TCJA of 80% allowable for the year. So when the TCJA passed, they said you can only take 80% of NOLs in a given year. So let's say if you had $100,000 in NOLs carrying forward and $100,000 in taxable income, you could only take 80% of that. That would leave you with $20,000 of taxable income that you pay the tax on. And the CARES Act says, you know what, for 2020, we'll allow you to take 100% of your NOLs that are being carried forward. So that is an option now. So with the carrybacks, you can file forms to get a refund on the NOLs if you carry them back. So that allows you to get a little bit of cash for businesses to run their operations. And the other thing it's a really hot topic at this point is what happens to the expenses. Are they deductible if we use the money from the PPP to pay those expenses? And at this point, the IRS's position is that we can't allow the business to get a tax-free loan forgiveness and also deduct the expenses of all the payroll that they paid using those funds. And we know that the members of Congress and the House Ways and Means Committee have indicated that the IRS isn't really doing what the purpose of the PPP was, to give the taxpayers the benefit. And I think they're working on legislation to kind of correct this in the future. So we'll just have to wait and see. That's all we have to go off of, is what the IRS's position is at this point.
Okay, Alex, thank you. Just one, and I think you said it, but I want to make sure I clarify it. With PPP, that tax deductibility issue as it stands today, that's dependent on getting forgiveness though. So if I don't apply for forgiveness and I just keep it as a loan, I still get the deductions. Why you would do that, I don't know, but just want to clarify that.
Yeah, it's only for the forgiveness, because the way the tax law is that if something's forgiven, you can't double dip and get the forgiveness and also use the deductions. And that being said, we want to make sure that we document everything that we do as far as the NOLs and the deductibility of the expenses go.
Right, and one more, just so that we do a quick example of what this means. If you get, let's just say you got a PPP loan of $500,000, and let's assume you got 100% forgiveness and you did everything you were supposed to, the bank did it, and let's assume it happens by year end, meaning December 31st, 2020, and your tax year ends December 31st, 2020. You have full forgiveness, and I'm going to use easy numbers so I can do the math without an adding machine. Many of you know me. If you take away an adding machine, I got 10 fingers. So if you got 500,000 and got full forgiveness and your tax rate was 50%, let's include state, everything, etc., you would have an additional tax of $250,000. Did I say that right, Alex?
Yeah, that is correct. That you have to pay the tax on that money, and that's what wasn't the purpose of the PPP loan, to do that. And now you end up paying half in taxes, which you should reap the benefits of. So, and that is the case at this point, and we'll just have to wait and see if when we get further guidance by the IRS or the new legislation that fixes this issue.
Right. I kind of wanted to clarify that for everyone in the business. Let me just say something. If you see Lisa or Alex stand up and wave their hands, they're sitting in our office, so we have motion sensor lights, so they tend to go off out of nowhere. So we apologize for that. That's just the way our building works. Just so everyone knows, I asked the self-rental question. We don't own our building. So thank you for that, Alex. Moving on, Dennis, we talked about the differences between EIDL and PPP. Would it make sense to apply to both? And if the answer to that is yes, how would you recommend taking best advantage of both programs?
Well, the answer is why not, right? I mean, these are two programs the government is allowing for small businesses that we haven't seen before. So I think it's kind of a no-brainer if you can. There are some reasons why you wouldn't, but we'll talk about that later. But you got to remember that the EIDL is different than the PPP. The EIDL, if you use it towards payroll, that's going to offset the forgiveness on the PPP. So try to avoid that. Use the EIDL for the working capital portion and choose the PPP for the payroll and related costs. You also have to remember there's a $10,000 grant. If you receive that through the EIDL, that will offset the PPP loan forgiveness. So you will need to pay that back in that portion. And so how do you take advantage of both? It's kind of like what I said. Make sure you use the EIDL funds for something other than payroll. And then you should not have an issue. I would figure that, as long as you have the payroll to cover the PPP loan, you should have no problems getting it forgiven. So take advantage of both if you can.
And this, I don't know, this popped in my head while you were going through taking advantage of both. With PPP, that would really say to me that it would have been better if I haven't applied yet, it would be better to have a separate account and transfer, whether it's into my payroll account or whatever the case may be, for better documentation. Is that
right? And I know some financial institutions were requiring a separate bank account. So they did help in that sense. I think that's the easiest way to do it. I mean, most companies would have a payroll account anyway. So they would probably have it deposited there, easily trackable. But yeah, I mean, anything to ease the burden when it comes time, I would recommend.
Thank you, Dennis. Moving on to the next question that we got. In a lot of the questions I've received in the past months, and we did see it in the registration, Lisa, there seems to be a lot of confusion on the costs that are covered, including retirement match contributions, and we talked a little bit about self-rental versus mortgage interest. Lisa, can you give us a summary of what costs are covered and maybe some examples?
All right, well, some of the costs that are covered or included in the payroll costs are obviously the payroll wages, the health insurance premiums, state and local taxes, and you did mention the retirement contributions, where I want to point out with the retirement contributions or even the wages, as long as they are earned / incurred by the employee and they are paid prior to the next payroll date, they are included. And the magical words here are they're earned and paid prior to the next payroll date. When it comes to the non-payroll costs, the non-payroll costs includes your covered mortgage interest, your rent expenses, your utility expenses. And what has been clarified with this is the covered mortgage and rent expenses. Previously, we thought it was just real properties that were covered, but they have specified that personal property is included, meaning if you have a lease as of February 15th on a piece of equipment or an auto lease, those expenses can be included in your non-covered costs. When it comes to your utility payments, I want to point out here again, if they're earned or incurred, and as long as they're paid prior to the next billing date, they are also or can also be included in your non-payroll costs.
Thank you, Lisa. Just to clarify, and this, I'm going to be honest, I had a conversation with Lisa within the last 3 or 4 days, and this is when I understood it. So for the match, for retirement match, if your match was for the year ended December 31st, 2019. Now, a lot of companies, they have a safe harbor, maybe they have a profit share. For that to qualify for forgiveness, you would have had to pay that before so if it's December 31st, you would have had to pay that before the next payroll period in January. Is that correct?
That's correct. So long as it's earned or incurred and paid prior to the next billing date, you're covered.
Right. So the likelihood of, let's just say we pay weekly, the likelihood of getting forgiveness on that is pretty low, because most business owners, when we pay a match annually, we end up paying it somewhere between March and May, depending on whether we extend our tax returns or whatever the case may be.
That's correct.
Okay. Thank you. A lot of information on this stuff. Dennis, jumping back, and you referenced that we would go back to this in the EIDL and PPP programs. What would be reasons not to use either program? Can you walk us through that a little bit?
Well, I mean, the PPP is going to be based on wages and self-employment income. So if you're a company that has no wages, you're not going to qualify. If you're a company that's heavily used 1099 contractors or subcontractors, probably not going to make sense. If you're a sole proprietor and you're not showing a net profit for 2019, you're not going to qualify, so it doesn't make sense. The EIDL is meant towards working capital, so there are items that you can't spend the money on, and that include dividends, bonuses, payments to owners, payments for stockholder loans or principal loans. You got relocation expenses, refinancing of debt, and then repairs or acquisition of fixed assets. So you have to be careful on how to use it. So look at what you intend to use the money for before you apply.
Okay. Just a quick, since we talked about dividends and bonuses, under PPP, I believe it was under the Flexibility Act, you can now pay bonuses as long as that bonus does not push someone above the $100,000 cap. Is that the case?
That's correct.
And it's employees, non-owners, if my memory's correct.
Right, correct. Yes.
Just want to make sure. Just to follow up on what you were talking about previously, how would I account for the programs, the various programs?
Well, right now we know the EIDL is a loan, so you're going to book it as a loan, and the PPP, until it is forgiven, is going to be booked as a loan on your balance sheet. So it's just debt. It's going to sit there until the application's approved by the bank, until you know what amount was actually forgivable.
Okay. Thank you, Dennis. Well, I just got a note from Krista in the chat. Please, everyone that's attending, don't hesitate to ask us questions. We know we're going through a lot of information. The idea here is for us to help you. So if you think of something that, I'll say something that people say to me all the time, there's no such thing as a stupid question. They don't exist. If you don't know, we're not going to say your name when we go through the chat. So please don't feel any hesitation. With that said, Lisa, we mentioned earlier some of the safe harbors that are available for businesses that were either shut down, required to close, or whatever the case may be. Can you talk about those a little bit?
Sure. Krista, are you able to bring up any of those PowerPoint? Thank you, Kristen. So here's basically some of the exceptions that do apply, or the safe harbors that were enacted. The first one being, I have heard from quite a few clients that trying to bring back their employees that they had at February 15th. For some reason, whatever reason, employees are choosing not to return to work. So long as you have your information documented, meaning the offer that you provided your employee is written, whether it's an email or a document, signed, dated, and you're offering them the same wages and the same hours, and for some reason, this employee decided to reject it, whether it's in an email or a document again, and you inform state unemployment. If all of this information is documented, you are not subject to any loan forgiveness reduction. It's basically putting out the good faith effort. You're trying to bring your employees back to work and they choose not to. There's not much more you can do. So some of the safe harbors that were implemented with the Flexibility Act was the FTE reduction. Basically, if your level of full-time equivalents, if you can see, it's been reduced from February 15th to April 26th in comparison to what it was at February 15th. If you're able to restore your FTE levels any time prior to December 31st, then you met the exception of any loan forgiveness reduction. Again, they're just looking for you to restore your level of employees. And now this third safe harbor / exception that they enacted with the Flexibility Act relates to compliance requirements that were put into place as of March 1st. If you can document that you cannot sustain the same business activity level that you had at February 15th, basically, they haven't issued any guidance extremely on how to document these records, but you cannot sustain the same level of business activity that you had, you would meet this safe harbor. So again, like I said, they haven't issued much guidance on this third safe harbor, but if you cannot keep the same level of business activity, you would qualify.
Thank you, Lisa. Just to clarify one thing, and we do have some questions in the chat, and I'm going to jump to those momentarily. With the FTEs, with the restoration of FTEs, this is an assumption of me, but I think most of us are probably thinking it. I shouldn't apply for forgiveness until I've restored my FTEs if I'm going to. Is that a fair
That's
assumption?
correct. That's absolutely correct. Now you do have until December 31st to restore them, but if you have any inclination that you would be able to, I would highly recommend waiting to that period.
All right. Now we have a couple in the chat. I'm going to tackle the first two because I know the answer, and then I'll turn it over to you guys. The first question is, are the rules the same for both businesses and nonprofits? The overwhelming majority are the same. The only difference for a nonprofit is if you got federal, state, local funding from, in a grant, a contract that pays people specifically, and that funding did not stop, those personnel that you paid with that other funding do not qualify for forgiveness. That would be a double dipping issue. But for the most part, the rules under the loan programs are the same. We have another one. If we received a PPP loan on May 13th, is that loan now under the PPP FA rules? The answer is yes. However, there is some flexibility. You can still elect the 8-week period for forgiveness if you want to. Again, like I think I said this earlier, and I think we all agree, if you're not 100% sure you're going to get forgiveness in 8 weeks, don't elect that. If you apply and or get your loan post June 5th, you're now only the 24-week period. So just to make sure that is clear. And moving on, is there any advantage to asking for forgiveness sooner than later? Is there an advantage over choosing 8 weeks or the 24 weeks? I'll take the 8 versus 24 week. For me, I would not choose 8 weeks unless I was 100% sure I had reached full forgiveness. That's just my non-authoritative business owner intuition. You know, I think, and any one of you can jump in on this, I think my understanding is even if you elect the 24-week period, if you think you've reached full forgiveness, you can apply before the 24 weeks. Is that correct?
Yeah, that is correct.
Okay, thank you. All right, I'm going to jump back. Okay, and well, this one I can definitely handle because, you know, I'm smart enough to handle this, I think. Will the PowerPoint slides be available after the meeting? Yes, they will be. Krista will send those out directly to all the participants. There will also be a recording of this session available. I don't know if it's a link or a file. I have to defer to Krista on that one. You know, once we start talking technical stuff on that, it's over here. Okay, I'm going to try and do this. Okay, we have one. What is included in utility costs in other costs? I understand that fuel for vehicles is included in utility. So
Joe,
what else is in that?
Yeah, I can handle that. Gas and fuel is included in the utility costs. To detail it out, it's your electric, gas, water, transportation costs, telephone, internet, cell phone, etc., and fuel is included. They did clarify that in one of the guidances that they issued.
And vehicle leases.
Yes, that's
okay.
the personal property side of it.
Okay. Just to add, the American Institute of CPAs has a great form. I don't know if they updated it for the PPP Flexibility Act yet. As of last Wednesday, they had not. But that has a great tracking mechanism. Krista, I can send that to you. If it's been updated, I'd be happy to do that, and we can send that out to all of the participants. Here's one, and this, Dennis, I'm going to look at you for this one. I applied and received PPP loans. Can I now apply for EIDL loans? And do I do so through my bank? I think that goes directly through the SBA. Is that correct?
Yes, directly through the SBA. Their website, right. That's the only place. So that would be, I looked yesterday, it looks like it's open back for business. So I would go online and absolutely attempt. Yeah.
Okay. I'm trying to do as many of these and group them as best I can here. So everyone, please bear with me. Okay, here's Lisa, just to go back. Can mileage reimbursement be included in the transportation costs, I guess?
Personally, I would say yes, because it's a reimbursement for travel expenses. And so long as you have your employees keep track of the mileage they had and where they traveled to, it's a travel/transportation cost.
Okay. Thank you. I agree with that 100%. I think if I was going to deduct it on my tax return under transportation, I would put it in the forgiveness application under transportation.
Exactly. And the same thing with the utility costs. Whatever is classified previously as a utility expense, I would highly recommend including it.
Okay. We have some specific questions on the loan forgiveness calculation form. I'm going to make a suggestion because I see who this is. I'm going to suggest that you reach out to me directly following this presentation, because I think if we tackle that, we're going to dig into a rabbit hole, and we're going to be on that for the next 40 minutes, because that form is just tons of fun. Here's one, and can someone, and you guys decide who you want to take this, can someone go over how you calculate FTEs?
Yeah, I can take that, Joe. To calculate the FTEs, there's a couple of ways to do it, and one of the ways is to take the average number of hours by the employees, and you divide it by 40, and then you round it to the nearest 10th. And the maximum for each employee would be about 1.0. And they also give us a simplified method, which you can assign 1.0 to a full-time employee and 0.5 for whoever works fewer hours for simplified purposes to calculate the FTEs. And the borrower, you have to use the same method that you use to calculate the FTE, or use an alternative method as compared to the reference period. So whatever you apply, that's the one that you want to use.
Okay, thank you, Alex. This one I'm not 100% sure, and I think it's a deeper discussion, but I'll ask the panel and the panelists and see what they think. For a not-for-profit, how would maintaining business activity level apply? Would it be based on program service fees, fundraising? You know, what kind of documentation? For documentation, I would think you would use prior year period versus current year period. But my guess would be total revenues. Is that a fair guess? I'm really not sure how we would do that for a nonprofit.
I would assume it would be the same total revenue for a nonprofit versus a for-profit.
Mm-hmm. Okay. Yeah, that's one that I think I again, please feel free to reach out because that's a discussion that I think is more broad, and I think that'll take a little more time. Oh, Krista just told me there is a link that will go out to the recording of this session. Okay. So here's one, and this is, any one of you can take this. Can owner distributions be considered payroll expenses?
No. No, if that's what they mean, distributions, if it's pay to him up to 100,000 or her up to 100,000, then yes, but if it's owner distributions, no.
It has to be a payroll cost.
Yes, subject to FICA and Medicare, right.
Okay. Okay, okay. Are health insurance premiums paid for an owner employee included or excluded from health insurance premiums in the payroll costs?
I know S Corp health insurance premiums for the owner are not includable in this. Okay, that's the only thing that I can think of that would not qualify. Other health insurance for employees, of course, and the owners outside of an S Corp.
Okay. We have one. We received authorization yesterday for $150,000 under the EIDL, but it states the SBA will require a blanket lien on loans over a certain amount. How will this work with existing bank loan requirements? So let me clarify, and I think I understand this, that there are other liens from the bank on certain real property, I assume. So now there's going to be a lien from the SBA. Would that be a second lien, or would that take precedence over the bank?
I wouldn't think so. I mean, I think it's just, again, they're trying to protect themselves, but there's always an order to that. So whoever's documented first would have, I think, first dibs. So no, I don't think they, just because they're the federal government, or that they get first dibs.
Who knows with the government anymore? Who knows? I think we covered that. I apologize, guys. I'm trying to get through. I think we covered all, and we have one more. And can someone step through the journal entries for reporting the loan, payments for payroll, loan reduction, and loan forgiveness? Don't all volunteer at once.
Right. To me, you're recording the loan, right? Okay.
So I think the question is, what's the journal entry?
Well, so you're going to debit the cash and credit the loan, right? And then the payroll and everything, I would just continue to record it like I always have. And then once you figure out how much of the forgivable loan is and what it applies to, you probably have two options. I don't know how the tax return is going to be reported, whether, you're going to have the lump sum forgivable amount and you as income, and you still report, you know, the actual expenses. But until we really know how they want us to apply that, it could be multiple ways. I mean, the easiest way would be to, once it's forgiven, is to debit the loan and credit income.
Right. And I would assume in a business environment, forgiveness of debt. I mean, that's what I would assume. In a nonprofit, maybe it's grant income. That's just a guess. I think that's what it would be. I think my assumption is okay there.
Yes.
Well, the good news is I think Krista just told me we hit all of the questions so far. So jumping back to some of the pre-registration questions, we've been through PPP, EIDL, and I know it's a lot of information for everyone, but Alex, there are some other, what I'll call programs for relief. And some are if you did apply for EIDL or PPP, and some are if you don't. Can you talk about those a little bit?
Yeah, Joe, there's some options available. And one of them relates to a payroll tax credit, which is the employee retention credit. And to qualify for that, if your business was fully or partially suspended due to COVID-19, or if your gross receipts dropped more than 50% in a given quarter compared to same quarter in 2019. And so this credit is available throughout the year, but once your gross receipts go over 80% in a given quarter compared to 2019, then the credit is no longer available. The credit is 50% of qualified wages up to $10,000 paid to employees, and the maximum is $5,000 per employee. And the qualified wages will depend on the number of average full-time employees that you have. If you have more than 100 full-time employees, the wages paid to employees who are actually not performing service are the ones that are included in this credit. So you're basically paying for employees who cannot do their job because of the COVID-19 related. And if you have less than 100, average of 100 full-time employees, any and all employees that you pay wages to. It doesn't necessarily have to be the ones that are not performing service. So you can pay to any and all employees.
Alex, just to jump back on that,
Yeah.
Is that 10,000 per employee or 10,000 total?
That's the 10,000 total wages paid for employees. So yeah. So it's
okay.
So the credit is $5,000 per employee. And the timing of the wages, if you paid wages after March 12, 2020 and before January 1st, 2021, those wages qualify. And the biggest questions I always get is, how do we get this credit? And it's on the quarterly payroll reports for 2020, the Form 941s will have instructions and lines there to claim the credit. And in some cases, you can get an advance payment of the tax credit if you file the Form 7200. And then those credits will be applied to the 941s for future quarters, will reduce the credit that you might get for the future quarters. If you're getting funding from the PPP or the EIDL, you are not eligible for this credit. So this is strictly for individuals and businesses who did not get the PPP or don't intend to apply for the PPP or the EIDL. And we know that you still have time to apply for the PPP through June 30th, I believe. The other option you have is payroll tax deferral. And I just want to clarify that this is a tax deferral and it is not a credit. So this basically pushes the taxes down the road. And you can defer the employer portion of the Social Security tax at 6.2% on wages up to $137,700 per employee. And you have to pay that back, 50% of it, by December 31st, 2021, and the remaining 50% due by December 31st, 2022. Just want to throw this out there. This is the 50% that's paid back is in addition to any payroll taxes that you would owe for 2021. So from cash flow perspective, you just want to keep that in mind that you do have to pay this back before those due dates. What periods qualify? It's any payroll deposits that were due after March 27th and before January 1st, 2021. Now, if you receive the PPP or EIDL, the date changes a little bit. the first date is the same, any payroll deposits after March 27, 2020, but the last date is until the decision from the lender indicates that the loan is forgiven. So once you find out that your EIDL or PPP loan is forgiven, up to that date, you can no longer defer after that date. So it's only up to that date. So this is an option for cash flow purposes to kind of push it down the road, but you just want to make sure that you do account for it on your cash flow, the budgets for your cash flows.
Thank you, Alex. And that's something that you would recommend calling your payroll provider. Don't assume that they know about it. Is that a fair statement?
Right, exactly. And ultimately, you are responsible for remitting the payroll taxes. And so you want to make sure that your payroll company is doing everything that they need to do. And from your end, make sure you have all the documentation, all the calculations that you use to come up with the credit. The more documentation, the better in case of an IRS audit. So I think those are the two programs that are available outside of PPP and the EIDL.
Okay, thank you, Alex. We have a few more questions. The first one I'm going to turn over to Lisa because you handled the what costs can be included. And can self-insured unemployment costs be included in those additional costs in the 40% percentage? And you're still on mute.
Thank you for that. I'm not quite sure about that one, to be honest with you. That's one I would want to check into just to clarify if that could be included.
Thank you. That's one that I'm not sure about either, and I don't know if Alex or Dennis, if you've seen that.
I haven't.
Yeah, that's one. I would encourage you to reach out to us, and we'll be happy to look into that for you.
I mean, maybe some clarification as to what the unemployment costs she's referring to. I mean, if it's related SUTA, state unemployment tax, absolutely. So perhaps that might answer the question.
Right. I think that might be a follow-up.
Yeah.
We're going to have to do a little more digging on that, and we're happy to do that. We have one, and Dennis, I'm going to turn this one to you. Do you have any suggestions for relief for real estate office building entities? They very rarely, if ever, have staff, so they really don't qualify for PPP. And many of them are having a hard time because tenants are not timely with payments because they're most likely shut down. And some are just not renewing their leases because they're either working remotely, they're either closed, whatever the case may be. What options would an entity like that have?
The EIDL is your option because one of the questions they'll ask you is what your lost rents were. So now's the perfect time, because I know when this first started, people were being nervous and they were being asked, well, how much revenue have you lost from this disaster? And it was a low amount. And I noticed that they were getting loans for that amount. So now's the time, because I would assume you've accumulated probably quite a bit of lost rents. And at least you could recoup that amount in the form of a loan. Remember, it's a loan. It's not going to be forgiven or anything. So, but it's a 1% loan payable over a long period of time.
EIDL is 3.75, I think.
Yes.
Is that right?
Yes.
Okay. I'm getting confused too. So
I know.
There's just all these new things in a 3-month period. Just in the interest of time, I'm sorry to cut anybody off. We're at 12:53. We have 7 minutes left. We are happy to stay beyond 1 o'clock to answer questions. That's not a problem for us. But I do want everyone to know that please do not hesitate to reach out to any of us. We will be happy to help you. If you can't stay past 1 o'clock, we perfectly understand your time is valuable. So we have one more slide that we want to show to you before we jump off. And Lisa, this is a timeline of, I guess it's a summary of all of the timing for, the loans, the forgiveness, all of the things, if you will. Can you give us a quick run through on it?
Well, this timeline It's basically a summary. Krista, if you can get the timeline, it's a summary of from the moment you received your funds through the end point. Krista, can you get the timeline up there? I guess not. Okay, so I can verbally go through this. So you received your funds. Here we go. So the starting point here is you received your loan proceeds. Your next phase is your covered period, or 8 weeks or 24 weeks, where you tracked usage of the funds. Once that is up, you have 10 months to submit your loan application to your lender. Once you submitted your loan application to your lender then has 60 days to review your application and submit that to the SBA. The SBA then has 90 days to review this wonderful application of loan forgiveness and inform your lender exactly what amount of loan forgiveness you've been offered. So instead of that 6-month period from the beginning of this timeline to the end, you have this good amount of time in between. You're on mute, Joey.
Of course I am. That's what happens when I try to watch the chat and everything else. We have one more question just came in for the real estate question. Should the entity apply for 10,000? And guys, if you disagree with me, please jump in. My thought would be, as Dennis said, you could calculate your lost rents. You can apply up to 150,000 if my memory is correct. I would go by what the lost rent is and maybe other damage and apply for that. The 10,000 is, I believe, forgivable.
Right. So I would go for the 10 as well, because I mean, that's the forgivable portion. When you go through the application, it's a click the box. Basically, it's like, do you want $10,000? And you're going to say, sure. Click the box and enter your bank information. And hey, if it hits the bank account, you're good to go. So I would definitely do it.
All right. And just to throw this out there, if the loss is more than 10, it's still a loan of, 3.75. I don't think any of us are getting corporate loans at those rates, especially for 30 years.
30 years, right.
So my thought would be, if you've been really damaged, I would go for that. I would take the loan. I mean, that's the unfortunate reality is that's your best option right now.
Right.
So with that, we're at 12:57. So I know in the interest of everyone else's time, I just want to thank everyone for joining us today. Again, we're happy to stay and answer as many questions as we can. And thank you, Krista, for putting all of our contact information up. Again, Krista will be sending out a very, very brief survey. We would appreciate if you would fill it out. We're always looking to improve. And, I think in this new normal, as we're told, I think most of our roundtable sessions are going to be more virtual than we ever expected. So with that, thank you for joining us. Please stay safe, keep your families healthy, and we appreciate you joining us today.